Welcome back, welcome back, welcome back. This is Tamara Manuel, also known as Tamara the Realtor, broker associate with Benchmark at Southwind Realtors. And I wanted to come on to discuss the topic of credit scores today. So, you want to purchase a home, however, you're not really sure about the credit score requirements or how does your credit score actually play a role or a part in getting a mortgage approval. So, let's first of all start off talking about what does a credit score consist of? There are four things that a credit score consists of. The first one is payment history. The second one is credit utilization. The third one is length of credit. And the last one is types of credit that you have. So I'm going to break those down for just a minute before we talk about the actual minimum score that's required to get a mortgage loan approval. So, payment history. Before a creditor, whether that be a mortgage loan, a new car, credit card, cell phone bill, whatever it is, and sometimes even jobs now will review your credit. They want to know what is your payment history. Are you good with paying your creditors back? Are you good with paying them on time? All right, so those are the things that can help with building your credit score by having good payment history, which means not only do you actually pay your debts, but you pay them on time as scheduled. All right. The second thing is credit utilization. This is a really big one because a lot of people don't know what credit utilization actually is. Credit utilization is how much of your credit are you actually using. So let's say, for example, you have a $1,000 credit limit. When you are going to apply for a mortgage or any type of credit for that matter, the creditor that is considering extending you credit, they want to know that you're not using up the entire balance to make purchases. So the ideal credit utilization percentage is about 30% of your balance. So if you have a $1,000 credit limit, 30% of that would only be $300. So instead of running that credit card up to $1,000 or $900 or $800, they want to see that you're only actually using about 30% of that, which would be $300 of that limit. That shows that, hey, I'm not desperate for money. I'm not desperate. I'm not going to overuse this opportunity of credit or for credit, but I am keeping it at a minimum, and I'm not overextending when I make purchases. So for your credit utilization in order to build your credit score, you want to keep your credit utilization to 30% of your total balance that you have or the total amount of credit that has been extended to you per account. Okay, so this is with all the credit accounts that you have. You want to keep that credit utilization to 30% or less. The third thing is length of credit. How long have you had these credit accounts? So obviously, the longer that you've had the accounts, the better that looks for you because it's showing, again, that payment history. You know, if you just got an account 3 months ago, future creditors don't know how well you're going to actually pay those amounts back because you haven't had it long enough to determine that. Most creditors like to see a history of 24 months of payment history in order to make a good determination on are you a valuable candidate for credit. And the last thing is types of credit. It's good to have installment credit as well as revolving. Installment credit is when you pay in installments and there is an actual end date to that credit. So for example, a car payment. You're only going to have a car note for anywhere between 4 to 6 years. So that payment is going to eventually end because you will eventually pay off that debt. That's installment credit. Revolving credit is like your normal credit cards where you spend, you pay it off. You spend more, you pay it off. So it's good to have more than one type of credit so that creditors can get a good picture, a good snapshot of who has extended you credit. So those are the 4 things that actually make up your credit score. Now, as it relates to a mortgage approval, it's really important to know that there are 2 types of credit reports. You have a consumer credit report, which is what you may check with Credit Karma or myfreecredit.com or someplace like that, versus there is also what's called a mortgage lender credit report. Their scoring guide and what they're actually looking for as criteria to determine whether they are going to extend credit to you in the form of a mortgage loan are 2 totally different types of credit reports. So be very careful in thinking that with Credit Karma, I just checked my score, or I check it regularly, and I see that I have a 690 credit score. Be careful in knowing that when a mortgage lender pulls your credit to see if they can pre-qualify you for a mortgage loan, oftentimes those scores are very different because the scoring model that they use and the scoring criteria that is used to determine whether you can get a mortgage loan are 2 totally different types of scoring models. So it's important to know, even if you go on Credit Karma and you see a credit score being shown to you, that's really more for educational purposes to kind of give you a guide as to what that mortgage lender credit report is going to actually look like. But the numbers more than likely will not be the same, which is why when you think you are getting ready to purchase a home, it's good to go in, get a lender, and always allow your realtor to choose or give you information on a lender to use, because certain lenders have different programs that may suit your needs for down payment assistance program, closing costs, and those sorts of things. So it's important to go in and know that just because I've seen this score on Credit Karma or myfreecreditreport.com, or if you have credit monitoring from a certain system or program, know that that score may not reflect the same when you get a mortgage lender credit report pull. Now, different lenders have different requirements. So there are some lenders that will require that you have a 640 credit score, depending on who that lender is. There are some that require a 620. As it stands right now, FHA loan will allow you to go as low as a 580 credit score in order for to receive a mortgage loan approval. Not all lenders will allow a 580 credit score, so it's really important before you choose a lender. You kind of need to have an idea of where you think your credit score may lie, and know that some lenders, not all lenders, have the same scoring requirements. You can go as low as a 580 in order to receive an FHA mortgage approval. However, different lenders have different requirements. 580 is the lowest score that you can get with a reputable mortgage company. So be very, very leery of anyone who will grant you a mortgage approval and your score is less than a 580. Also, it's important that you have 3 credit scores, one from TransUnion, one from Experian, and one from Equifax. Lenders are going to take those 3 scores, put them in numerical order, and whichever score is in the middle, that is the score that they use to determine if they're going to approve you for that mortgage loan. So let's just say, for example, you have a 650, a 599, a 622. Well, the score that in numerical order, the score that's actually in the middle is the score that they will use to determine whether or not they're going to approve you for this mortgage loan. Aside from what the credit score is actually made of, or what it consists of, and the fact that there are 2 different types of credit reports, you have your consumer credit report and your mortgage lender credit report, it's also important to know that a mortgage loan approval is not simply just about your actual credit score. a lender that is going to loan you hundreds of thousands of dollars, they want to know, they're looking at a snapshot of how well you pay your bills, how well you pay those creditors back. Do you pay them back? Do you pay them back on time? And do you do that consistently? That's extremely important to them, because if they're going to loan you this amount of money, they want to make sure that there is very little risk involved as it relates to paying back your mortgage loan that they will decide whether or not they're going to give you. Another thing that's really important is your debt to income ratio. So it's not just about your credit score. It's also about how much money do you have going out in comparison to how much money you have coming in. Hence, debt to income ratio. Most lenders will not allow you to go over 45%, which means your debt can only be about 45% of your total income. There are some lenders that will go up as high as 56%, and some that will go as low as in the 30s, 33%, 35%, 38%. It depends on the lender. So this is really important to know before you actually select a lender. These are questions that you would want to ask your realtor before choosing a lender or deciding who you're going to go through to get a pre-qualification or pre-approval letter. The third thing that they want to know is, can you show documentation of your income? They're going to want to see check stubs, your W-2s, your tax information. They're going to want to see bank statements. They need to see these things to determine if the information that you've provided is actually true and accurate, and they need to know, are you a stable prospect to receive this money or this loan to purchase a home. Buying a home is one of the largest investments that most people will ever make in their lifetime. And before a mortgage lender will lend you a mortgage loan, they want to know, are you a good candidate? Are they going to get their money back? And how much risk is involved if they were to lend you this money? So those are just a few of the things that are really, really important to know before you actually go out and apply for a mortgage loan. Keep in mind, it's really, really important that you choose a realtor, a licensed realtor that is aware of what the lender's requirements are before you actually go and put in an application. Because for every single time that you put in a mortgage application, that's an inquiry on your credit report. So it helps if you know what you're doing and you know who you're going to, you know what the requirements are before you even submit that application, so that there are not multiple inquiries on your credit report. I hope that this information was extremely helpful to you. I look forward to coming back and giving you more information and knowledge that you need to make the best decisions for you and your family. Tamara the Realtor signing off. Thanks so much for listening.